Hello and welcome. You're watching Business Today TV. I'm Sakshi, Batra. Well, the RBI policy is out. The RBI governor has announced a 50 basis points hike on the repo to 5.4%. And now to decode the policy outcome, I'm joined by three very special guests. With me on this panel, I have Madhavi, Arora, lead economist, Emkay Global Financial Services, Pankaj, Bansal, chief business officer at bankbazaar.com, and Siddharth, Zarabi, managing editor, Business Today TV. Welcome, panelists, and thank you so much for taking the time out for this discussion. So the repo rate is at 5.4%, now back to the pre-pandemic levels, in fact, highest since August 2019. The MSF bank rate revised to 5.65% as well. Let me begin by first thoughts from all of you. Madhavi, starting with you, your first thoughts on the rate hike. Is it as per your expectations? And also the stance at withdrawal of accommodation.
So we were expecting close to 35 bips of a rate hike. So a tad surprised in terms of the quantum, but not necessarily to surprise the fact that they have chosen to front load, their policy action. So technically, since the June policy, domestic macro backdrop has marginally changed, while the global financial conditions are actually stabilized despite massive hike that the US Fed had done recently. To some extent, even global externalities have incrementally become more stable, and market are expecting near peak inflation and Fed hawkishness, which is essentially led by the fall in the entire commodity price complex that we are seeing. But that said, as even the RBI mentioned, that the situation is still fluid, and the macro assessment might require frequent adjustments ahead from the policy perspective. So I think to that extent, given the fact that Fed has already reached the supposed neutral rate, or as per the calculation, RBI is yet to reach a supposed neutral rate, which is around 0.8 to 1% in terms of real rate. I think there appears a valid argument as to why RBI chose to front-loaded rate hike, though we were still expecting more like a 35 bips rather than a 50 bips in this current policy. But nonetheless, I don't think the stance or the tone was very different from what we saw in June. And I personally believe that this incrementally you will probably see rate hikes coming off only in terms of the quantum.
Okay, we'll come back to that with you. Pankaj, your take. How did you read the governor's comments? Is it more like a hawkish hike or a dovish hike?
So I think it was broadly expected 35 to 40 basis points, but 10 basis points here and there, it's fine. But now if you look at the rates, right, Sakshi, when we pre-COVID, it was about 5.15 as our, repo rate. Now today is about 5.40. So you are far higher than even pre-COVID level. So pre-COVID in October 2019, we were at 5.15. Today we are standing at 5.40. So it's technically, I would say a 25 basis point kind of a gap. Maybe it's on the higher side. External markets are difficult. Everybody knows this Ukraine war and all that stuff happening. Inflation still at 7% plus, But the good news is that economy is growing. GDP is still at 7.2% is what Mr. Governor is saying. So I think that's a very positive sign, I would say. But for consumers, it's going to be like mammoth. From 7% when they were getting a home loan, today getting at 8.4%. So I'll tell you a very simple example. If you want to hear it out for the consumers, I'm sorry. But the fact is that the loans are getting very expensive. 1.4% extra that I will shell out. So the EMIs, which were like just when the rate started, right? The EMI was about 38,000 for a 20-year loan for a 50 lakh. Today's loan is 3,000, right? So it's like a 5,000, 4,600, 700 rupees monthly outflow, which will be borne by a consumer who has taken a 50 lakh loan at a 20-year kind of a scenario.
Well, hold that thought there, Pankaj, because we would want a little more explanation on that as we move forward into, because that will be extremely important for all the borrowers watching you right now. But Siddharth, I'll take your first comments as well. Your key takeaways from the governor's speech, and what more would have you wanted to really hear?
There are three key takeaways in my book from the RBI. The first is that the 50 basis points hike now ensures that the RBI has, in fact, overcorrected as far as reducing inflation in its attempts to reduce inflation. However, it has not projected a significant decline in inflation anytime soon. It has continued to talk about uncertainties. What does this mean for the next monetary policy review? I believe that unless there are any further black swan events or shocks, the tightening cycle may now take a pause. Because at 5.4, monetary policy's impact on inflation will come ahead And that will mean that growth will slow down next year. And at some point, the MPC members will start arguing about the inflation versus growth trade-off. So in the simplest possible terms, has this cycle reached a peak? I believe we are near the summit, unless there are shocks. The second point, where is inflation headed, which is where all of this really started, the withdrawal of accommodation.
Yes.
Inflation, according to me, will now be guided by crude and the farm sector. The farm sector, we have seen the monsoons had a uneven, patchy start, but are equally distributed. However, new sowing is down by 20% plus. So you will continue to see stress. The biggest headline relief that India is likely to see is with crude oil trending downwards. Just a few hours back, we have noticed that there is a $5 per barrel difference between Brent and the US benchmark, the US benchmark being lower. And if Russia continues to support India with lower priced crude, we know that we have had a significant benefit. Then by Diwali, our policymakers, both in North Block and in Mint Street, will have more room to breathe easy, Sakshi.
Okay, understood, Madhavi. How many more rate hikes do you really anticipate from now? Your sense on the pace and the length of the monetary tightening cycle? As earlier, we had always heard the RBI governor talk about how he wanted to ensure a soft landing for the economy. And where do you really see the repo rate by the end of FY23?
So for RBI, the good thing is that Indian economy looks to be still resilient. While we are seeing clear signs of global slowdown/recession, we'll see how it really pans out globally, because I think for the rest of the world, especially the developed markets, the kind of inflation they're seeing is something very new. For India, 6%, 7% is something that the policymakers have been used to for the last 20 years. I mean, in fact, our estimates suggest that almost 50% of the instances in the last 20 years have seen inflation above 6%. So it's not something that the policymakers are new to. So that, as I said, incrementally, we are not looking at them raising rates in such high quantum. My terminal rate continues to be close to 575, 585 around, which is essentially implying that we would see 2 rate hikes more, possibly a 25 bips quantum maximum. And that is where they'll end. So either December or March, but I don't think beyond 5.75 or 5.85, they would be moving.
So not a 6% as is being talked about.
6%, yes. But then see, again, 10-15 bits doesn't make much of a difference, honestly speaking. So as per their own estimate, the real neutral rate that they would like to see at a rate at which, they are sort of neither restrictive nor accommodative for the policy is close to around 0.8 to 1%. If I look at their forward inflation, which is, ending or my estimate rather, which is around 5.3, 5.4% a year from now, I think we would be fairly okay with a 585 kind of number for terminal rate. But we'll have to see, because as I said, the situation globally is very fluid. Recessions globally have been very, very strong disinflation agents. So things will change in a matter of 6 months before you realize that the whole argument or the whole story has moved from peakflation to stagflation to recession, and how recession can lead to a very sharp disinflation. So we'll see how it pans out. As of now, I think, given that India tends to lag the global recession in terms of slowdown, I think fairly okay at 575 around that number on the terminal rate.
Okay. Pankaj, like you were talking about, the impact on banks and borrowers. So far, including today's hike, I think it's 140 basis points hike. So far, the 90 basis points help us with understanding of how much have banks passed on in terms of the lending rates. And with this, what is your expectation?
So broadly, if you ask me, Sakshi, today, this rate hike like 50 basis points, obviously 800 rupees will come to, I'm taking an example of again the same 50 lakh loan at a 20-year tenure. It's about 800, 900 rupees that a customer will have to shell more if he's talking about EMI increase. But if he's talking about tenure increase, I'll tell you a very simple example from when we were 7%, right? Broadly, when the rates did not rise, it was at the bottom end of the pyramid. The customer was absolutely paying 240 EMIs. Today, he'll be paying 334 EMIs. If he doesn't do anything, 240 EMIs to 334 is a 1.4% increase, which has happened in the last whatever time frame that RBI has done. So it's a massive increase. I will say, if I had to put in a number, 240, 130, 34, and 240 is like 100 EMIs extra that a customer has to pay over a period of, 20 years. If I put in numbers, it will be 36 lakhs of interest extra that a customer has to pay, right? So these numbers are very, very significant in terms of when we look at it a macro. But when you look at an EMI, you just look at 4,000 rupees extra EMI, doesn't matter. But if you look at massive number, a 50 lakh loan, you have to pay 36 lakhs extra interest. Look at what is the impact a customer has. So it's a huge impact now on customers' cash flow. And as I told in the last my discussion as well, I think the key input I will give to all the consumers across the board: please prepay 5% of your outstanding every year, and you will be safe. And I think that's a mantra. It's a scientific mantra. Don't do anything silly. Just pay 5% additional outstanding for your this thing. Your numbers from 20 years, even the rate hikes will decrease significantly. So I think that's the simple thing a customer should do. I would always suggest that. And second thing I would do is that even evaluate in terms of they want to refinance their loan from somebody else, because if I have a good profile, I'll get a better rate. If I don't have a good profile, I won't get a better rate, because now the numbers are becoming meaningful. Now, today you're talking about if my loan is still 15 years, 17 years, 10 years left. It makes sense for me to even get a 50, 60 basis point reduction in my existing home loan rates, because today you don't have pre-closure charges. So I would suggest these two strategies a customer should look forward to. And I'm sure this will be really helpful for them for their management plan.
Right. So prepayment and refinancing, those are the two options for all the borrowers at this point in time. Siddharth, just like how Pankaj pointed out, I mean, like, these numbers are significant. These are going to make, loans and EMIs very, very expensive for the common man right here. So right now, the governor was talking about how credit growth is like encouraging. So far, the banks are reporting good numbers. But can this increasing rate scenario really put a stop right there? Can credit growth and credit offtake be, held ransom?
We've known that there is never a right time to buy or never a right time to sell. It's outcome of multiple circumstances. If you have the money and if you are secure and confident about future earnings, people take a bet still depending on what they want to acquire. So it's also a behavioral, psychological decision. And I believe that what is likely to happen as a consequence of this interest rate hike is that a burden on existing borrowers will go up, as was pointed out by Pankaj through calculations. You would see some further impact on the affordable housing segment, according to me, not on the premium luxury segment. And remember, affordable housing has almost disappeared. And I know these are strong words from the market. Anecdotally, and I can turn this question around to all three of you and ask you to tell me, do you recall in the last 1 month or in the previous in the festive season, how many affordable housing advertisements did you see? And what do you expect happening in the Dussehra Diwali season? So let's be clear about that. The pinch is also going to be felt around, somewhere around auto loans as well. Pankaj again would know more about that. And in that, Sakshi, one quick point, and this is, some people find it difficult to comprehend. We had July tractor sales and two-wheeler sales going down. However, we saw a new car model getting massive bumper bookings, which will obviously be spread over 6, 8, 10 months of delivery cycle. So there is a contradiction in the economy. The well-off will be less hurt. The pinch is going to be felt at the lower end of the middle class segment, Sakshi, according to me.
Absolutely. And that's going to be making problems worse for the common man. And Madhavi, the key concern, like Siddharth had earlier pointed out, that inflation, which started off this rate hike cycle, what do you make of the comments today of the governor on inflation? According to you, has inflation peaked? Because we saw 7.79% in April. So is that worst of inflation behind us? Because now we have a new number of 5% on the Q1 FY24 that the RBI governor has talked about. So on two accounts, do you think the inflation levels have peaked out, or on the other hand, they are likely to be persistent considering the problems of crude, like what Siddharth was pointing out? The geopolitical tensions, they've not gone away anywhere.
Correct. So I agree with him. So we have clearly seen peak inflation. They're not going back to a 7.8, 7.9 level again. But I think, as the governor was also mentioning, that we will probably see elevated inflation pressures in the near term. We still haven't seen the full pass-through of past input cost hikes that we have seen, so which essentially will weigh on the output prices, which means the core inflation could again remain sticky. And essentially, with the still resilient demand back home, I think this would again imply that you could see a sticky core inflation in the near term. Plus, we also found the tax increases in number of consumer goods, including gold and also the iron depreciation, which could also be an additional price pressure ahead. So I think on net, I'm still of the view that inflation will, probably surprise on the downside mildly compared to RBI. So they're expecting 6.7%, while we still continue to see around 6.5% for the year as a whole. But that said, I think my near-term estimated inflation looks to be pretty sticky at this point in time, which implies that the pressure is here to stay. And as we mentioned before, there are a lot of global uncertainties. We don't know how they pan out. They could actually be positive for inflation for all given the disinflationary pressures because of recession that could play out in the world. Or geopolitics would actually worsen it further, wherein even with a slower growth, certain commodities which are essentially driven by supply side factors could still remain very high, which could even lead to a worse hard landing in the world. So I think we'll have to see how things pan out. At this point, I think we need to accept the fact that global uncertainty remains extremely high. The world is still debating what will happen after peak inflation, whether it's signing for disinflation, whether disinflation going ahead is going to be linear or not non-linear, and how the policymakers, including the RBI, will navigate their path, because it's not going to be a smooth one for either of them.
It's not going to be a smooth one. Siddharth, you wanted to make a point here.
I just wanted to say one last point on the show, and I'll take it away from the macro to the micro and the markets. If you had 10 lakh rupees in the stock markets today, pure stocks, equity, okay, I'm not talking about anything else, you've gained roughly 8,800 rupees on your portfolio today, depending on what kind of, let's say a 1% gain, to be more precise. Now, what does this tell you? The Sensex is up, the Nifty is up. The markets have priced in and perhaps are expecting, and Pankaj and Madhavi may like to agree or disagree. The markets have priced in and are perhaps now expecting the RBI to go soft, because the macro picture for inflation, without repeating the previous point, may be better than it was a month or 2 months back. The question mark in my mind is what will happen once the impact of the hike so far starts translating on the headline growth number. Maintaining it at 7.2% is par for the course, but if this plays out in the manner that it seems to be, I think we should be prepared for a revision, downward revision on the growth number as well, and that impacts government revenues, that impacts spending. So it's fine for the moment. The markets are also taking it in stride. Will it be the same 3 to 6 months later? We'll perhaps have to meet again around the festive season to do a fresh assessment. Sakshi.
Absolutely. Well, thank you so much, Siddharth, for being with us. You have to go for another discussion on India Today, so we'll let you go. And we'll continue our discussion for 5 more minutes because we have some more points to talk about. And Madhavi, I'll take it away to you first from what Siddharth left us with. The growth projections retained at 7.2%, but are there downside risks, keeping in mind that we do not know the current global uncertainties you talked about? How will they really pan out?
So our growth projection is around 7%. At this point, still fairly balanced. As you rightly said, global uncertainties are, pretty high at this point in time, and we need to see whether when India really follows suit. But India tends to not decouple for very long. If we are seeing a global hard landing really happening, I think there will be time for us to start revising our growth forecast downward. But I think at this point, I'll still stick to my guns and keep my focus at 7, while being very watchful of what is happening around the world. Because we're clearly not going to outgrow the world in terms of incremental growth rate.
Yeah, absolutely. Pankaj, your thought, do you think that growth is still in fine fettle, or does it need more handholding by policymakers both on the Main Street and North Block?
So I think my view, Sakshi, is that I think the good news that Mr. Governor said is that there is no probability of recession, at least in the country. So that's very important statement to make, right, from a confidence booster standpoint. I would still say there are two major risks that we see. One is this Taiwan escalation, which has just happened 24 hours back, right? There are challenges. Semiconductors is a big industry that we operate, right, through Taiwan and all. And second, Ukraine and Russia are still into that conflict zone. Still, there is no resolution that we have seen. So the only silver lining, what Siddharth rightly said, is the barrel price, crude price in terms of per barrel. And if that comes down, obviously we will see something easy. But the fact is today, nobody can predict what's going to happen because it's very, very global, right? It's not something that India in isolation can talk about. But what we can talk about today is that I think this 8.4 is I think the rate at which, and maybe a 5.4% on repo side, I think is a very reasonable number now.
Yeah.
Beyond this, will start stretching, on the growth side. Till this point, obviously, this is technically maybe just 25 basis points higher on the pre-COVID level, which is fair. But because the accommodative stance has now moved to a complete rationality now. So that accommodation has moved to rationality from an economic standpoint. But I would say now, I think going forward from here will be tough. It will start impacting growth. If I improve,
it will start impacting growth.
Yeah. So
deeper rate hikes will start impacting growth for sure. Madhavi, what did you read about the rupee comments? I remember that the RBI governor did talk about that. So far, the rupee has remained okay in terms of what they were expecting. How worried should one really be on the fact that the dollar has been strengthening and the rupee still remains sticky at around 79 kind of levels? And because I ask you this, because the current account deficit and the trade deficit are two broader concerns. Never before in an RBI governor's statement have we really seen a full paragraph being talked about on the deficit part, how imports are rising and the deficit is being widened. So how do you really read all those statements?
See, obviously, with regard to the external sector risk, that's the first thing any emerging economy has to take care of in light of what is happening at this point in time, which is a global uncertainty / recession, flashpoint. So clearly, to that extent, discussions with regard to external sector are, understandable. That said, I don't think the INR pressures will dictate MPC policy decision too much at this point in time, because while the dollar has appreciated against a bunch of currencies, as he also mentioned in his policy speech, the rupee has essentially been more or less in the middle of the emerging market path. That partly would have been also on account of the fact that RBI was doing consistent intervention in all of its spaces, be it spot, forwards, or futures, which essentially even led to a dislocation of the forward premium in the month of June. I think global mood had nearly stabilized in the last few weeks or so after the FOMC rate hike, and the market assumed that the peak hawkishness of the Fed is already done and dusted with. That said, I think given the fact that we still see a decent amount of pressure on the balance of payment, INR I think could still have more leg of correction first, but I think I'd be positive in the rupee going forward, say in the year of in the next 6 to 9 months period. But I think near term, there appears to be pressure on the INR, and Central Bank obviously is trying to contain that by both intervening and keeping the policy rate relatively more, balanced as far as the carry trade against the developed market is concerned. So I don't think that's going to be a very major decision point as such for them to manage the currency, because they have been fairly doing a decent job in the last few months or so. But of course, if the rupee pressure intensifies too much, I think RBI will have to take further action beyond just the rate hike. But rate hike won't really help the rupee much unless, of course, it is complemented by some curbs on current account and probably even the capital account.
Sure. One more point on the liquidity front, if you could mention, what did you read in the fine print about the liquidity? Is it still on the comfortable level? And the way the RBI is going to monitor it now?
So I think on liquidity front, they seem to be okay with the fact that we have seen a very sharp deceleration in the surplus liquidity. And in fact, the RBI mentioned this time around that they would keep it more two-way from here on, wherein both repo and reverse repo on the variable front would be on offer. My sense is that liquidity should be improving going ahead because the government spending hasn't yet happened. I think the government is sitting with a decent amount of cash which has to be deployed in the system and which will lead to improvement in liquidity. But I think RBI is now watching the fact that they are pretty much close to, less than 1% or 1.5% of NEPL in the liquidity. So I think they will start doing a two-way repo and reverse repo functions on the overnight basis.
Okay. Pankaj, there was something very interesting also in today's commentary, and that was on how the RBI governor talked about now NRIs can pay home bills now. RBI has proposed to enable a Bharat bill payment system to accept the cross-border inward bill payments. Could you share some significance and thoughts on this and how this will be really, impacting the banks?
So I think both sides know outbound and inbound is something on the forex side. There are a lot of developments which you'll see and coming in both from a bill payment perspective and even forex perspective. So I think both ways we actually will wait for the time to come back with the kind of fine print that comes out.
Yeah.
But there, I think the idea is very clear that outbound also in the forex side, there will be going to a lot of disruption happening in that space. And I'm sure the way India NPCI has developed their outbound ecosystem with IMPS and all that, it just has to get converted into money. So you will see a lot of change on the forex side that will come outbound as well, inbound as well. It both ways it will flow, the money will flow. But I think we just wait for the final prints to happen in terms of how the structure looks like, how it is going to impact. So that's something I would maybe wait for some time and then maybe look at.
Last thoughts then, Madhavi, what will you be watching out for in the presser now? Something that you thought that has remained unanswered in the first comments made by the RBI governor?
So last time around when we talked about inflation forecast, being close to 5.7% or 6.7% or so. They had essentially mentioned that it sort of does not keep into consideration the fact that RBI is going to tighten further, which could lead to further curb in demand or inflation. I think this time around they haven't mentioned that. The inflation forecast has remained unchanged, but they haven't really mentioned the fact that they are considering further rate hikes or not in that policy projections. Apart from that, of course, on liquidity front, because that I think is something that we all need to understand what is the comfort zone of RBI as far as the net liquidity system, liquidity is concerned.
Okay. Pankaj, your last thoughts?
I think, I would say overall a good policy note. I didn't expect any hiccups that I would say. We were looking at 35-40, it says 50. So it's majority on the same side. Not much of a difference, I would say. But going forward, I think we'll have to be very, very, cognizant of the fact that from here, the growth will get impacted as our view, very strong view on the credit side. And on the credit offtake from a retail perspective. So hopefully this is the end of the rate hikes. That is my, stated.
Okay, let's keep our fingers crossed because we still have not got any indication from the RBI governor that they are on the pause front at all. But for sure, consumers are in and borrowers are in for some kind of more pain on their wallets. But thank you so much, Madhavi and Pankaj, for being with us and sharing all the insights on the RBI monetary policy outcome. And we'll have you come again on Business Today TV to share some more insights on the detailed fine print after the presser as well. Thank you so much for being with us.
Thanks, Sakshi. Bye, man.
Thank you.